Investing with IBD is brought to you by AllianceBernstein, a global investment manager offering active, flexible solutions across asset classes. AB has the tools and expertise investors need to get their portfolios ready to navigate late-cycle investing. To find out more, visit abfunds.com. Okay, hello everybody. Welcome to Investing with IBD for March 20th, 2019. I'm your host, Arusha Pierce, and joining me in the studio this week is once again Chris Gessel, Chief Content Officer of IBD. Good to see you again, Chris.
We're doing this again. They haven't kicked us out yet, but we're having fun.
Now, I hate to break it to you. Eventually, you're going to have to get out of that seat.
Really?
And rotate a little bit.
Okay.
I don't know.
All right.
No one may roll it to you. But.
All right.
So today we're going to review the current market, the life cycle trade. So these stocks, these great growth stocks, have a life cycle. So we're going to get into that. And as always, we're going to end the episode with some current stocks that are popping up on our radar. But before we get into the current market, next week, Chris, it's a special week. It is MarketSmith Free Access.
Oh, yeah. Awesome.
So March 25th to the 31st, once a year, anyone can go and try MarketSmith for free. Okay, and this is my product, and this is a product that I'm absolutely proud of. And so you get a chance to go and try our top-tier product, no credit card required. You get to go and see pattern recognition, see stocks breaking out, get alerts on stocks breaking out. And so definitely take advantage of that. If you're not a MarketSmith subscriber, come hop on aboard and give it a shot. So March 25th through the 31st.
Well, let me just say something that I use your product every day. And in fact, it's just part of my morning routine, going through what's breaking out, what's setting up, looking at the Growth 250. So it's really integral to what we do at IBD, and everything works together with it.
Yep. And with that, let's get into the current market.
All right.
Okay. So the current market continues to grind higher. It continues to do well, right? And continues to confound everybody.
Right.
Everyone's waiting for that pullback. We got a brief pullback, but everyone's still waiting for this big correction to come back, or this another bear market or something. But that's why we have rules. That's why we listen to the market. We have 5 distribution days on both the NASDAQ and the S&P 500. And a couple of things that I noticed, the 50-day is also starting to trend up too. The 50-day moving average is starting to trend up too.
That's a great sign. I think what you said, grind higher, and the first few weeks everything was going up day after day, and maybe there might be a few days of pullback, but it really seems lately that we are kind of entering a grinding phase where you can be, well, for example, this morning, up a lot in the morning, down a lot in the afternoon, and then even to maybe down a little bit by the end of the day. So it's a little more challenging. Challenges your I guess your calmness. It
does, and I think it gives credence to not watching the market too closely too. If you're watching, if you're going off of every news headline that's coming out. And I know for both of us today, it was crazy days. I didn't get a chance to watch the market that much at all today. But when I got back, people were saying, "Wow, it was kind of all over the place."
Yeah, definitely.
But I didn't necessarily see it. I just saw how it closed, and so there definitely is something to do that where you want to just kind of, if you're in stocks, if you and the market's in an uptrend, a lot of times the best thing you can do is do nothing until you get a true signal.
Yeah, and so far we've been looking at the market, getting extended. We knew that there was going to be a pullback, and there was more, I guess, 2 weeks ago. And last week was fantastic. We bounced off of that. It was wonderful. Great week all around. This week it's been a little bit more back and forth, and so. I mean, it's just the nature of the market right now. The good thing, though, is if you look at the S&P 500 chart, we had talked last week and the week before, or just in general, we've been talking about this, about the S&P getting over the 2815 mark. And so now it's closed, it looks like about 3 days straight over that mark. So that's a good sign. Hopefully it continues to hold above that, and then assuming if we maybe get some support at the 10-day moving average like we have so much during this initial rally off the bottom, then the next goal is getting back to the old highs around 29.40.
Yeah, and underneath, and we spoke about this group last week, the software stocks continue to act well, and they continue to lead the market. A number of medical stocks, healthcare stocks, they're also starting to act well. They're starting to come up on the radar. Yeah. So really, when you're in a good rally, you want to see a broad-based rally. And that's what we've had a lot of participation from a number of different industry groups. And so when you see that type of environment, you want to give it a chance.
Right. Although lately there haven't really been that many breakouts because most of the initial breakouts have already happened, and there's some other things setting up, but they're not as powerful looking as the initial breakouts.
Which makes sense. The January 4th was the follow-through day. We're 10 weeks into this, more than 10 weeks, 12 weeks into this. And so a lot of the best stocks have left the building at this point. And so now you'll have another set of stocks starting to build bases, but sometimes you don't want to necessarily go for those lagging stocks. Maybe build that watch list of the leading stocks and wait for them to set up another base or pull back to their 15-day moving average.
Right. And I mean, while you're waiting for the market to offer up new opportunities, we get some headlines that maybe start casting some doubt, and I guess one of them yesterday was FedEx earnings. They missed, they guided lower, and so that was taken as a big sign of, well, maybe this global slowdown has some credence to it, although the U.S. economy is doing pretty well, and obviously the stock market is convinced that it's doing all right. So that was weighing on stocks early, and then there were some headlines about it was kind of funny. Trump saying we're going to keep the tariffs even if the deal gets done. Oh yeah, and the deal's coming along fine. So that kind of like, what's that about?
And speaking of the trade war, so that's all going on, and then you have, of course, the Fed and the interest rates. Now that fear is no longer as much of a fear,
right?
But with this trade war. Even if it happens, right, and hopefully it eventually happens and they come to some kind of agreement,
right?
A lot of that's baked into the market. That's the magic of listening to charts, listening to the market. A lot of the market's always looking forward.
Yeah, but I guess another way to look at it, maybe what's happened so far with the trade war has baked into the economy, right. And we really could be facing a slowdown. Now, the nice thing about that is earnings started to slow down in the fourth quarter, at the beginning of the fourth quarter. Really, that's what caused the correction in Q4, was that companies started reporting and their estimates were much lower than people expected, or they weren't beating as much. So what's interesting now, I've been looking at some of those numbers, and a place that I always go is Ed Yardeni's website, yardeni.com, and he's a longtime Wall Street economist and really a numbers-driven guy. So kind of cut from the same cloth that we are, that we'll look at the data first and then try to figure out what's going on. And the nice thing is, so Q1 earnings down 1.5%, but after that, earnings growth starts picking up again. Not a lot. Q2 is 1.1, Q3 is 2.6, but Q4 is 9.4.
Wow.
So the end of the year, we could really start seeing some growth. And really what's important is what the market thinks is going to happen. And that those numbers that I just recited kind of explain why the market is rallying, even if maybe some of the headline numbers coming out in recent weeks haven't been all that impressive, and why other people are saying, well, this is just a rally in a bear market.
And so for now, we don't have that earnings recession, right? Mm-hmm. People are there's always that talk too. But the forward estimates, they are starting to pick up after trending lower since October.
Yeah, and I think that's the big takeaway, is that they had been dropping down. I think we had showed some of those charts back in our level 4 Cancelim Masters presentations, and now they've just started to tick up. Mm-hmm. And maybe it's the first week or two, but that's a good sign.
Okay, so another thing, and we get this question a lot. with the distribution days.
Mm-hmm.
So we have 5, both on the S&P 500 and the NASDAQ. And people get worried if you get up to 6, 7.
Right.
Should you run out at that point? Should you sell everything and head towards the sidelines just by using distribution days as your signal?
Yeah, I wouldn't do that. I would understand what the distribution day count is, and then look at what the action, the market averages, and the leading stocks. And that's been maybe one reason, over the last few days or last couple of weeks. There's some days when, like today, the market was down modestly, maybe down 0.5% or so, and leading stocks were down double that or maybe triple. So there's always that element that leaders amplify what's going on in the market on the upside and the downside. And the other thing that we haven't really talked about is small caps, which were absolutely crushed during the bear market. Have come back strong, but in the last couple of weeks, they've not been rallying as much as the S&P and the NASDAQ, and so that's been an issue. And today they were down probably the most of any of the indexes at the lows.
And we generally want those small caps to do well because that's telling us that the market is willing to take more risk. There's more speculation, and so that if I pull up the IWM on that's been struggling on the. It's meeting resistance on the 200-day moving average. Right. There. Had a strong rally since January, but right up to that 200-day, it hit a ceiling, and now it's coming back. It's almost it's acting the way everyone assumed the S&P and the NASDAQ were going to act.
Yeah,
right?
That's a really good point.
And so that one, the small caps haven't necessarily participated as well as some of the other the mid caps and the large cap stocks. And so that's definitely a concern right there. But keep an eye on it. You don't want to assume, you don't want to predict. Interpret the market, and in the end, listen to the market. So the key is the market is still in a confirmed uptrend. Obviously, you want to keep an eye on those increasing distribution days. That's always that always serves as one warning sign. But I think, as Chris mentioned here, the bigger warning sign for me over the years has been the leading stocks, has been my stocks.
Yeah, exactly.
It's the stocks. I'm going to always feel it there. And even when we sold off in Q4 of 2018, my stocks started getting hit pretty hard in September. And so that naturally forced me to cash. Then the distribution days kept collecting, and then the market started to really crack at that point. So it's always both the market and the leading stocks. That way you're going to get a much better picture of the overall environment.
Yeah, and so right now, I mean, leaders, even though they might move a lot more than the general market, in general, if you're looking at their charts, the charts look fine. There's very few things that are showing any signs of weakness right now. So.
Yeah, and they especially look fine if you're looking at weekly charts. And we all have a tendency to look at daily charts,
And then 5 minutes.
Exactly.
What have you done for me lately?
Right. But the weekly charts, that's the true picture right there. And so a lot of times if I find myself getting too antsy and starting to panic a little bit if my stocks are getting hit hard, I pull it up on a weekly chart and say, okay, what's the kind of the true picture of it? Now, sometimes I might lighten up. Okay, let me lighten up a little bit just to acknowledge that, okay, yeah, some of these stocks are getting hit, but the primary trend is still intact when I look at the weekly charts.
Right. And one thing I do, I note on my charts, do I think this stock is going to be a big winner? Or is this more of a 20%er where I'm expecting to take a 10 to 20% profit? And so, I know what I want to have conviction in, and when the market starts acting unusual, sell those ones that you don't have conviction about, or that you don't have sizable gains. There's nothing to defend at that point.
Right, and what one easy way to do that is sort your portfolio by performance and then cut from the bottom.
Right.
Too, right. So those are all good tips there. And so up next, what we're going to do, and this is a good segue here, we're going to discuss the life cycle of a stock. And when we talk about life cycle, we're talking about those big winners, the ones that you want to try to hold on to a little bit longer while you're cutting some of those, what I call tier 2 stocks. And so stay tuned. You're listening to Investing with IBD. Hey guys, Arusha from Investing with IBD here. The global economic cycle is moving into its later stages, creating a less favorable mix of growth and inflation. Central banks aren't providing as much fuel to keep things moving either. And market volatility has come back in a big way. All of this makes investing a lot more challenging today. AllianceBernstein can help. AB is a global investment manager with the tools and expertise to get portfolios ready for a more difficult path ahead. That means finding stocks from companies that are able to deliver quality growth over time. Adding downside protection against market downturns is critical too. And even though interest rates are rising, investors shouldn't avoid duration in their fixed income exposure. The bottom line, investments will have to work harder to generate long-term returns, but that shouldn't mean that investors have to struggle to find answers. AB offers actively managed flexible investment solutions across asset classes. It's what you need to adapt your portfolio for late cycle investing. To find out more, visit abfunds.com. We're back with Chris Gessel on Investing with IBD, and in this segment, we're going to talk about the life cycle of a stock. And so these stocks, these great growth stocks, we call them model book stocks.
Right.
But these great winning stocks that we all aspire to catch at the beginning, hold it through this long run, and, the life-changing type of
sell
events.
at the tippy top.
Sell exactly at the tippy top. And so for this example, we're going to talk about Facebook. Because Facebook is, now looking back, it's a classic, a winning stock, great growth stock, a model book stock. But it didn't start off that way. Now, this was probably Facebook. Yeah, I think Facebook was probably the most hyped IPO that I've ever seen.
Absolutely.
And so I remember when we were at MarketSmith, we were taking calls. Every call was, how do I get Facebook IPO? How do I get Facebook IPO? And really, at that point, I was like, there's no way that this stock can work right from the beginning. Because if you have normal people like us wanting a stock, there's no way that Wall Street's going to let us win. And the IPO failed immediately. I think it was a great lesson on why we wait for a setup. Even an IPO, we wait for a setup. We're not in a rush to get it because there's going to be time. We can let the stock set up. And we wait for IPOs, we wait for what we call an IPO base. It's a really, really short base. It's only 2 to 3 weeks long.
Sometimes
maybe
much shorter.
Less. Yeah, even much shorter than that. But that's the shortest base we'll wait for. And Google had an IPO base. Home Depot had an IPO base. And so when Facebook went public, we were waiting for that IPO base. But fortunately, I guess for those who didn't buy it right from the start, Facebook plummeted. Right, I think it opened up maybe I want to say it opened up at 40, and then it got cut in half or something like that, if I remember correctly.
It might have had a few days of holding up. I remember talking to people saying, "When should I sell it?" And I said, "I don't know, 20%." Just know. You can't really judge anything about a stock so early on.
Right. And so here's Facebook. It got cut in half.
Yeah.
Took a year and a half off. And everyone kind of gave up on it. Oh, Facebook, it's done. But this is when Facebook started to really excite Wall Street. On July 25th, 2013, they reported their earnings, and they had an EPS surprise of 31.6%.
Mm-hmm.
And they had what we call a breakaway gap. And so what a breakaway gap is, it's a breakout, but the stock is also gapping up. But this wasn't just a little breakaway gap. This was a massive breakaway gap. On that day, on July 25th, 2013, it was up 29.6%. And the volume on that day, above average, against a 50-day moving average volume, it was up 749%. Now, anyone who, any normal person who's not using charts or not using bases to buy would have thought that you were crazy to try the stock at that time. But if you know charts, if you know what a breakaway gap is, and if you understand that Facebook actually had this potential to become one of these monster winners, you were probably buying it at that point.
Yeah.
And over the next few days, because after that, then it really started to act like a great winner and took off.
Yeah. Well, in that week when it broke out, it closed the week up like 31%. And, people are, oh my gosh, it's so extended. Actually, one of the things that we learned while doing the research to make the breakout stocks index was that big breakouts are really powerful. And sometimes they can be difficult to, you got to grin and bear it and buy it and hope it doesn't fill the gap. But especially first stage breakout gaps like that, when you've got a company with great sales and earnings growth, it's really a good time to get in.
Yeah, and so this was finally Facebook was there, and no normal person, no retail person wanted to try it at that point, and that's why it worked. And it's amazing how the market always works like that. It shakes out everybody, and then the stock has the true power to work. Now, a few other things with Facebook at that time. The reason why they excited Wall Street, they had started to prove that mobile was working. They could generate a ton of revenue from mobile. And so now you started to have funds falling over themselves to get into Facebook. And they were the ones, the ones who were crazy enough to buy Facebook when it was up 29.6%. It was those funds. They just kept, hey, we don't have enough Facebook. We're behind the story. We need to start buying it. And so that was the start of this classic run with Facebook, and really this is the beginning of its life cycle.
Right. And so that life cycle lasted for really 5 years, where it made these initial really big moves, and then it would base and break out again. And it never really, after that initial rally out of that first, the first two bases, it really became a more sedate stock and was just, was following up on its 200-day line. And, overall, it gave really good gains. But it was a stock that, if you just sat back and held it and didn't get worried about the machinations day to day, you did very well in it. Yeah,
and you mentioned the 200-day moving average, Chris. The first time it had a clear break of the 200-day was on March 23rd of 2018. So almost 5 years. Right. And so if you had those shares at $30, $33 on that breakaway gap back in 2013, you were up huge, and if you had the patience, you were up huge at that point. But Chris, you're absolutely right. The one thing that kind of threw me off on the stock was that it started to trade in a little bit more mild-mannered. The first kind of run was classic, kind of great growth stock behavior. Then after that, it just kind of traded like a large institutional stock.
Yeah, and actually, if you go online and look at the chart, starting in July of 2017, its relative strength line really stopped its upward trend and started going sideways. And so the relative strength line is how the stock performs versus the S&P. So if it's going sideways, it's doing no better than the S&P. And then you got to start asking yourself, should I be in a stock that is just doing what SPY is doing, and I've got all this company risk? This is an issue that comes up all the time on Leaderboard when we're looking at stocks, and maybe the breakout looks nice, but the stock has a history of just matching the S&P, and that's not really what we need to find. We need to find stocks that will beat the S&P.
Unless you held all of your shares at $30, then you're probably on a boat somewhere.
That's true. But the thing was, for really the last 18 months before the big break in the stock, it stopped truly leading. It was just following the market, whereas before it had always been a big leader. And that was one of the reasons we had it on Leaderboard. We had it on early, and we put it on and off a number of times. And then we had it in 2017. And one of the reasons that we took it off was because the market's going up and that RS line was going down. It's like, well, this is not working for us. Let's get rid of it.
Now, let's talk a little bit more about the concept of a life cycle and late stage bases.
Right.
Okay, so I'll just kind of give the overview of just kind of a life cycle of a trade, around 18 months long for these big winners, and then they'll take time off. It's not necessarily mean that they're done with. They just might take a bunch of time off, and then maybe they'll start a new run. But they have they're going to have bases. We count bases as they keep moving up, and a late stage base, usually a third or fourth stage base, that's where we'll get a little bit more concerned. So ideally, when we buy stocks, ideally out of a first or second stage base, that's where you have a lot of the potential at that point. Around the third stage base, more people start to know about it. Fourth stage base, they're talking about it everywhere on TV.
Right. Yeah, but the thing with Facebook is because it was kind of a stair-stepping stock, it didn't have those big runs and then big pullbacks. It was just really solid and moving up. Its base count never got that high, and really what the overall thing to think about was, okay, this is a stock that's been rallying for 5 years, and now for more than a year, it's really not leading anymore. It's going sideways, and so that was one of the I guess flags that maybe the run was nearing its end. And then the other thing for me, just from a technical point of view, in that last base, and I guess it was in early 2018 when it broke out, there just wasn't any volume on the breakout. It just limped across the buy point, and even though it went up, the next few weeks, it was like it's hard to kick yourself for passing on something like that when it just doesn't have that power that you normally want to see when it's crossing a buy point.
Yeah, unfortunately for me, this was one of the few low volume breakouts that I tried.
Oh, I'm sorry.
And so I was up 10. I was like, Facebook, it's coming back. Let me get let me get some position in this stock because it's still meandering along, and so I'll just get a little bit. It's like I was really treating it as a counter trend kind of stock. A lot of times you have these really fast moving stocks. You want to have a little bit slower moving stocks also in your portfolio. So this is my slower moving stock. And it did move slowly to the upside, but unfortunately on the earnings in July of 2018, 5 years since after that breakaway gap to the upside, it had a massive gap down to the downside, 18% that I was lucky enough to participate in on that. But you're right. It kind of went against everything that I usually do. I look for high volume breakouts out of nice bases. This definitely wasn't a nice base, but I said, let me get some Facebook here. It's a big company. How bad could the earnings be?
Right.
The reaction be, and so it was a good lesson for me. Now the one thing that I've learned to do very well over the years is I sell immediately in those gap downs. If I get caught, I'm out. I was down, and it went much lower. So you can't be a deer in the headlights at that point. Yeah, I was down 18% on that day, but I just had to say, you know what? It is what it is. Cut your losses, move on.
Exactly. Yeah, and that happened, I guess, in July or something like that. So, well before the correction started, and then the correction started, and so now you're in a weak. If you held it, you're in a weak stock that is now going even lower, and I think it probably lost about 44% or so from the ultimate high. The nice thing is it's come back and it's going sideways, and if you look at the chart, it's really in this area. It's trading right in the 160s right now, and it's been in the 160s. It was back in maybe August of 2017, so really a year and a half without making any net headway. So you could argue that it's reset the base count, and it technically has reset the base count. Maybe it's something to keep looking at, but now you come back to the fundamentals, and what drove it before was it had huge earnings and sales growth. And what we are seeing lately is it's posted the slowest sales growth in 4 or 5 years. It's in the low 30s right now. Those estimates are supposed to go into the 20s over the next 4 quarters. So it doesn't have the power that it once had, and the earnings estimates are even worse, where they were in the 40% range, or for many quarters. Now the estimates are, I think next quarter is like maybe a 1% loss, and or decline, I should say, in earnings, and then small gains of low single digits the next 3 quarters. So something has to change in the business to re-energize those earnings, and that seems hard to believe right now when We've got, the EU, going after everyone over privacy concerns. There are people in Congress who want to break up all the big techs. And, there's I think people are becoming more and more aware of how their data is being used and maybe less likely to use that. So there are definitely some fundamental questions. But if the stock sets up, the earnings come in, it shows, some real power. This could be something that will come back.
Yeah, in the end, listen to the market. The market is always looking forward, and they reacted to those earnings estimates. And so Wall Street, it takes these funds time to get out these stocks too. They build the stocks up, and then they take some time to get out. And so when they see those estimates starting to decrease, the trends start to decrease, they're going to tiptoe as much as they can out of those stocks. And so the key here is to pay attention to where your stock is in a life cycle. If their stocks are in a later stage basis, keep that in mind. If they've been running for quite a while, remember 18 months is kind of the average for these runs. And so keep that in mind. And so you're going to be taking a little bit more risk at that point. Now, I do want to add one thing. Let me ask you this, Chris, first. Late stage bases, do you try them? Do you buy out of them?
If they're a true late stage base, I generally do not. I mean, I'll buy some third stage bases, but typically I'll be looking for a 20 or 30% gain and then get out. So I'm not trying to kid myself that something that's already gone up 200% that year is going to do it again. Occasionally it happens, but it's not too often. But we'll get into some details when we take a look at some other stocks of how you can really analyze those bases and know whether it's a true late stage base or maybe you can make a case that it's setting up again.
Yep. So up next, we're going to talk about a few current stocks on our radar. So stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. Okay, you're listening to Investing with IBD, and this is segment 3. So, Chris, let's get right into it. Let's get into some current stocks. And so the first stock that we have on the list is Intuitive Surgical. And this was a stock that has had a few runs.
Oh, yeah.
Right?
It's been a big winner multiple times.
And the last great run that it's had was in 2017. Everyone forgot about the stock. And here's Intuitive Surgical forming a cup with handle, breaking out of it, and going on a great run in 2017.
But I think that the bigger lesson is that this whole idea that we were talking about of life cycle of stocks. So when it came back, when it came out in 2000, it really wasn't until 2004 that it started moving, and then it had a monster move, right, and basically got knocked down by the financial crisis, and did not start making new highs again for probably 4 years after that. So a big uptrend followed by dead money time. Although there was coming off the bottom, you could have traded it
right.
and done well. And then again, it went sideways for a long time from 2012 until 2015, and like you said, last year in 2017 and 2018, it really started moving again, and I guess it more than doubled. It almost tripled, didn't it?
Yeah, and I actually just pulled up a monthly chart on Intuitive Surgical too, and you can only see like a big cup with handle from 2012 to 2015 that it started to emerge out of. Which is that's even that much more confirmation that it's a significant move at that point, and a longer term kind of buy signal is happening at that point.
And generally, when it was going sideways, those were periods where earnings had slowed down and the company was revamping its process or updating the surgical tools, and then it took off again.
And okay, so And so it started off in 2017 with a cup with handle. It went on a great run, but it started to slow down again around. Well, it started taking a break, I'll say, in the fall of 2018. And it formed a double bottom, which was undercut, and now it's starting to come back. It's right near new highs again. It reset its base with MarketSmith when we were looking at the pattern recognition. It reset its base there, so there is an undercut. But Chris, why don't you talk a little bit more about, you started talking about this in segment 2 about giving it a year time or a little bit longer time. If it goes sideways, that can also kind of reset the count in your analysis.
Yeah, well, with Intuitive, I mean, it's undercut, and it spent a lot of time, before the correction and during the correction, underneath its 200-day. I guess it really coincided with the correction. So now it's back near the new highs. So it's a true reset. Although, I mean, the last new high was in actually just the week that the correction started in October, the week of October 5th. So, I mean, that's now what, 5 months, 6 months?
Yep. Around 6 months or so.
Yeah. So that's a good amount of time. I usually like to see, longer, 9 to 12 months or even longer for a stock to really reset. So we'll have to see about that. The RS line is looking pretty good. The estimates are okay, 10% in 2019, 15% earnings growth in 2020. So that's about half of what the recent numbers have been. So if it starts beating those and showing a lot of power and surprising Wall Street to the upside, this could be something that would start moving again. Although it makes big moves, but it takes some time to do it. It's not a screamer.
Right. And one thing I think with this stock right now, it didn't have that powerful breakout. It formed that cup with handle, and it had a low volume breakout.
Right.
And it pulled back, and so it's just kind of slowly just meandering upwards, which is not, once again, it's not necessarily terrible. It's kind of the escalator to riches, especially for this stock if you look on a monthly or longer term chart. But yeah, it's not one of those. It hasn't made the cut, at least for me, because I'm usually looking for those high volume breakouts.
Yeah, I think maybe we'll have to wait till the next earnings report comes out. And if it shows power, then that could be something to look at. But I think that the bigger idea is stocks can be great. They can take off sometimes years and be off your radar, and then they come back again. So just because something had a big run before doesn't mean it can't return. And again, it's usually going to be because those earnings and sales are back in phase again.
Okay, let's go to our second stock, and it's Shopify. Ticker symbol is SHOP, SHOP. And Chris, let's go into a little bit about this stock.
All right, let me call it up. I'll do it one of these times. I'm learning how to type.
Well, but while you're trying to pull up the chart, Chris, I'll give a little bit of insight here.
I did it.
Oh, okay. Well, it formed a larger consolidation. It had a great run also in 2017. And now this is a newer company. They IPO'd back in 2015, and they're doing a lot of great things on the fundamental side, on the story side, and so naturally it took off. It was one of those first, I think it was one of the first stocks to break out in 2017, and it just went on an epic run at that point. But like all these great stocks, especially these kind of stocks that go through its life cycle, it took a break, built a large consolidation, which 28 weeks long. But you had some interesting analysis going to this where it might be longer than 28 weeks in this one.
Yeah, because if you take a look at the chart, it actually, the meat of that recent base was around 140. Well, that also corresponds to the high and basically the buy point of the prior base. So really, if you look at this, people have been, going sideways in this stock since March of 2018. So as it was starting to break out in February, it really had been going sideways for a year, even though that last base did not undercut the previous one. So it at least in the pattern recognition, it comes up as a 5th stage base, and normally I wouldn't want to touch that. But when I see that length of time where it's been going sideways, that gives me, I guess, confidence that maybe it's time to for another run. And it, spent a fair amount of time below the 200-day. Now this one is on leaderboard. I think both of us.
We both own this one. Yeah.
So, it seems to me that it, a new phase is working. But again, technically, if it doesn't continue to act right, I mean, I'm not going to just sit there and say, I think that this thing really did reset its base count.
Right.
I'm going to be selling if it doesn't act right.
And a few other things here. Within the consolidation, one thing that I really liked is that it shook out a lot of people. It kept undercutting its lows. And actually, we have a concept called 3 waves down. And so it really made 3 waves down where you just kept undercutting, scaring out everyone, taking out everyone's stops. And then finally, you got rid of everybody. And so now the only people who have the stock are the ones who truly believe in the story, and they're really betting for a longer term kind of gain here, and they're going to hold the stock longer. And so once the market came around, this stock has been up, it looks like 10 weeks in a row, and then it broke out, and so far up 14% from its that large consolidation.
Yeah, and the thing you said about how it was shaking people out, they were fairly fast shakeouts, and really a clue that it was really starting to lead was in December when it went back to the lows of its base. It barely went lower, whereas the rest of the market made a big move down.
Right.
And so that's why the RS line was starting to rise up. And again, we talked about that last week, is during a correction, we're looking at stocks where the RS lines are rising because we want that sign of relative strength. And those often, if they're showing relative strength during a correction, when the market turns, often they will carry over to the new uptrend.
Yeah, and this uptrend has proven that theory correct again. That those relative strength line is huge for us during a correction. So, Chris, let's go into another stock.
Okay.
And unfortunately, both of us don't own this stock. And this one is. Ticker symbol is GH. It's Guardant Health. It's a new company. They just went IPO in October of 2018. And the one person who does in this room, in this studio here, that does not own it is me.
That's too bad.
and thanks, Chris. We've been spending a lot of time together. It would have been nice to, hey, why don't you take a look at this stock?
Well, I'll tell you, going back to the life cycle of a stock. So where does the life begin for a stock? It's with the IPO. Mm-hmm. So I pay a lot of attention to IPOs. And again, in MarketSmith, I'm looking at the IPO screen all the time. Really, I want to see the ones that, ideally have good earnings and sales growth. But the reality is so many companies are coming public now before they're truly profitable. So there's a few out there, not many. And one thing I've been noticing, and actually Shopify was one of these stocks too, it started running before it had earnings.
Yes.
And so, I was kicking myself, and because I guess, for so many years, it's like, if it doesn't have earnings, we're not touching it. I mean, Bill would never touch a stock
like that.
Yeah. And so it's been very hard for me personally to look at stocks that don't have earnings and seriously take, meaningful positions in them. But I've just been noticing how many IPOs really start moving when they are showing great sales growth. And I'm not just 20 or 25%. They've got to be like 30, 40, 50, 60%, really meaningful amounts over many quarters. And Guardant has that. And so then I looked at it, and it's like, oh, it's doing cancer testing, and they don't have to take tissue samples. It's I guess just with blood tests. So It's a whole lot easier. It's cheaper. You know more about this stock than I do.
I think you took the 2 points that I knew.
Okay,
No. But it's called liquid biopsy.
Okay.
And so what's kind of cool with this technology that Guardant Health is using is that you don't have to actually cut out. Cut the tumor or whatever out to see if it's cancerous. There, you can take a blood test, and they can test these cancer cells they're releasing DNA, and so it's looking for that DNA in the bloodstream. And so from those blood tests, they can start getting a probability whether it's cancer or not. And so now, instead of this high cost going into surgery, cutting it out, doing all that analysis, you can do a blood test and do a routine blood test, much lower cost. And I think that like Medicare is now approving this process because it's going to save them like a couple of $1 billion on it. So it's a very, very interesting story. And if this is the beginning of a great run, the good news is that it's just getting started. Right now, that being said, I don't want any of you listeners to go running out and buying GH on Friday morning. We all have to be patient. Now, Chris is in a different story than me, and so I have to be patient. I have to let the stock set up, set a base, find some support on the 10-week line, but it's definitely on my watch list because it's a very, very interesting story. And so, you definitely want to just keep an eye on it.
Yeah, and the whole thing, I was watching this. It was in a cup. It was building a handle, and I think it was probably in late January, it started moving off the bottom of the handle. And that's actually a swing trading setup that Justin and I use for Swing Trader. And so this one was too thin to put on Swing Trader. It was actually kind of on the borderline for me, but I liked the sales growth. I like the fact that if you go to MarketSmith, it's got over 100 A+ funds in it.
Wow!
So it was telling me like, okay, there's something going on here, much more than what you normally see with an IPO. Plus the sales growth, and admittedly, it was off of very small numbers, but it was growing.
And it also had a powerful breakout. We were talking about high volume breakouts, 131% at the breakout, and it finished right at the top of its range. And so it was kind of one of those no-brainer. People were going after the stock at that point.
Well, the nice thing was I was already in it, so I just got to watch that. But
we know, Chris.
Oh, sorry about that. So, but the thing about it too was it took about 3 weeks for it to finish that handle, and there were the market was it was making me nervous because this is not the normal type of stock that I would buy. So I guess I got in early, but I didn't add there, so I could have done that. But it's gone up really nice. It's done. When it gets extended above the 10-day, it's been pulling back normally, and then there was that big earnings gap last week where it was up a huge amount. So so far it's acting right. I've actually hedged it a little bit with some puts just in case things fall apart. But this is the type of stock that you're always looking for.
Absolutely. So let's go into a couple more stocks that are starting to come up on the radar. A couple of IPOs. The first one is StoneCo, ticker symbol STNE. And so this is a new stock, a Brazilian stock that just came out in October of 2018. And great earnings and sales, and it just reported earnings again a couple days ago. Chris, why don't you tell a little bit more about this?
Well, this again, it's IPO, so we're definitely looking at that. And unlike a lot of other IPOs, this one is actually profitable, and it's showing great earnings and sales growth. And I believe what really started this thing rallying off the bottom right side of its base was news that Warren Buffett, of all people, was moving into it. So that caught our eye, and we've covered it a couple times. And so it's broken out. It's a little extended now, although it's pulling back. It's definitely one I would keep an eye on. And, there's an added risk. It's Brazilian, right?
Right.
And at least on Leaderboard, we have a history with Brazilian payment stocks. PagSeguro was our other one last year that had a beautiful breakout and ran up, 30%, and then almost completely round tripped that gain before we sold it, and then kept going lower. So again, if there's any problems with the world economy and people feel like the trade war is heating up, this thing could really take a hit if we look at PagSeguro and see how it performed when when emerging markets started coming under pressure.
And one more stock here, Farfetch, ticker symbol FTCH.
Right. It's the stock of the day. And again, another IPO. This one is not profitable, and there's not estimates. Actually, I guess, no, it's still expected to be losing money. But again, we're looking at sales gains of 64, 55, 52%, and 55% over the last 4 quarters. So that kind of growth, at least on the sales side, catches my attention. It had a big gap up on earnings, and now it's consolidating that. Fell about 20% or so. So maybe we'll get a cut base forming here. Definitely one to keep an eye on. And, again, if we can't find these stocks that have earnings, let's at least get the sales.
So keep an eye on these IPOs. And it's always a great thing to learn about these great stories. Some of these companies are doing amazing things, and they have the potential to change the world. And finally, always remember that life cycle. These IPOs they're a little bit more risky, but remember, in the life cycle, some of these are just beginning, and they could go on a pretty good run for around 18 months. So thanks, Chris, for being here. And that's it for this week's episode of Investing with IBD. So next week, we have a special guest. We have Randy Watts. He's the Chief Investment Strategist of William O'Neill. And we had a conference call with him yesterday, and he has a lot of great insight, especially on the kind of the macro environment. And he was explaining to us what's going on with interest rates. And so I think everyone's going to really enjoy this episode, so you definitely want to tune in. And once again, as a reminder, MarketSmith free access next week, March 25th to the 31st. Definitely hop on. This is once a year we have this, so it gives you a chance to try our top-tier product, MarketSmith, for 1 week for free. Thanks for joining, everyone. I'm Arusha Paris, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.